So what do you think makes investors lose discipline?
Typically, this can happen during market when the volatility is very, very high, especially some asset classes like equity can be more prone to volatility.
For someone who's hearing this word for the first time, how would you explain a registered investment advisor to them?
So advisor in very simple terms is the one who will handhold you from a long-term point of view, from a medium-term point of view as your goals may be.
Is there something you would like to tell a person who is seeking advice but is hesitant to do so?
There are times when probably you might be aware of a lot of things, but there could be a lot of other times when our awareness would be limited. So in all these cases, you would need a support of an advisor.
One tip that you would like to give to our listeners. With his 18-year-long journey at Nippon Life Asset Management, from research and banking to product ideation, Rajesh Jayaraman has seen it all, and we are blessed to welcome him on board on this podcast. You've spent over 2 decades in the banking and asset management. So when you look back, what's the one change that you notice and you would like to share?
Sure, it's been an interesting 2 decades of journey, and especially from an asset management perspective. One big change which you're seeing is the investor awareness today. So investors today are getting more mature. They understand each asset class has its pluses and minuses. And somewhere along the line, one big development which is happening, people are now actually getting geared to look at asset allocation also, which was not the case. It was to a good extent, people used to be only chasing returns. But now the awareness is better. There's also the awareness in terms of they need to build in risk management to their portfolio. So that's one big change which I'm seeing.
You must have interacted with a lot of investors and advisors over the years. So what's the one mistake that you often notice a lot of investors making?
I would say mistake. It is more of, it's basically we say there are 2-3 things which happen in the market. So there is always greed and fear. In fact, a lot of people will say that markets get driven by just 2 emotions. One is the greed to make more money, and second is the fear of losing out. The truth lies somewhere in between. Actually, the real good experience we want to get, it's somewhere in between. At times, people can get impacted by both these emotions. For example, if one asset class, say for example, equities, has done phenomenally well for a few years, there's always this feeling of missing out, FOMO as we call it, correct? Then investors want to chase returns, and probably they will get into the wrong time, into wrong kind of products. Wrong from a risk management perspective, from a what kind of risk they are taking. The other is when things are actually turning in the markets and things are getting in favor, they would still be hesitant to take that call because they just looked at the previous few years, returns have not been good. Should I come now? Should I wait? And these are some common impact which happens. I again would not say it a mistake. It's just an emotional thing which can happen to anybody. The real ability is to transcend both this, and that's where they probably can take help from advisors to get their portfolios made in such a manner that they don't get impacted by the short-term reactions in the market.
So during volatility, when the market is shaky, what do you think is better? Like, should investors take decisions based on fear, or do they look for the opportunity?
So basically what we say is these emotions will always be there, correct?
Right.
And there is no single strategy. The only medicine out here to get overcome this kind of anxiety which you get because of market volatility is just do 2 things very clearly. One is asset allocation. Have the right mix of asset class. So in case some asset class has gone down and you want it to be higher proportion in your portfolio, add to that, reduce that, whatever be the case according to the mix, maintain that asset allocation mix. Second is be disciplined. If you have said I've come with a particular time frame in mind, let's not get swayed by what's happening in a 3 months time, 2 months time, and then change everything and run around. So this is the common challenge which all of us would face. So which is why we say rule-based investing can help you tide over this. So one is get your asset allocation in order. Second is stick to the investment discipline. These are the 2 mantras for a long-term investment success.
So what do you think makes investors lose discipline?
So as I said, it's nothing but the emotions. See, finally, all of us are human beings. It's quite natural for us to have emotions. And typically this can happen during market when the volatility is very, very high, especially some asset classes like equity can be more prone to volatility. Even some of the newly favored asset classes like the commodities can have very long cycles where they do very well or very badly in that cycles. So there can be times when people are investors, anybody can lose patience, and probably that could be the time when the asset class is actually turning and you would tend to make mistakes at that point of time. So this is the reason why all of us tend to lose. So it's basically what we also need to remember is it's important to build in an element of risk management when you allocate. So investment is not just about returns, it's also about managing your risks in a wise manner. So put it in a very simple context. If you invested 100 rupees, if the 100 goes down to 50, it's only a 50% fall. Okay. But that 50 to come back to 100, you need a 100% increase, which is that much more challenging. So if you build some kind of a risk mechanism that your fall is not 100 to 50, the fall is only 100 to 75, then the catch up becomes much more easier.
For someone who's hearing this word for the first time, how would you explain a registered investment advisor to them?
So registered investment advisor as a name itself, it's just a fairly, I think, very good way to explain the concept. So basically you're looking at getting and hand-holding. So it's like a coach. So typically we look at sports, we get this thing where there's a mentor, there's a coach who helps you understand your challenges and helps you to overcome. Similarly, an advisor can understand and plan for you. The advisor can do a very comprehensive asset allocation plan for you, saying that what's your goals, short-term goals, long-term goals, medium-term goals, and assign products which are suited to match those investment needs. So that's where the advisor comes in. So advisor in very simple terms is the one who will handhold you to try and create a long-term wealth creation for you, will help you create a plan from a long-term point of view, from medium-term point of view, as your goals may be. So align your goals with the right kind of investment products. That's what an advisor will do. So you could say it's a matchmaker kind of role. So you will ensure that your goals on one end and what kind of products you want. So he's the one who will guide you with it.
Why do you think the concept of advice is often confused as selling in India?
So there is always this worry which people have, and rightfully so, because every economy, every country goes through transitions phase, correct? So there could be this apprehension that people might have that are they being sold some product just because it's lucrative for somebody else who's making some higher money out of it, and hence they have been sold products which are maybe suboptimal for the investors' needs. So that's the worry which people can have. But the fact is, finally, when you look at from overall picture, and as I said, every economy evolves, every market evolves, every product also evolves. So with time, there's a lot of checks and balances which come into the entire framework. So today there are a lot of guidelines, regulation which ensure that there is a lot of transparency in whatever happens. See, the biggest thing which an investor would need is a lot of transparency. So probably in earlier times, or when the thing just started, and when the people were just taking baby steps in this, the transparency element could have been a little lower. And that's why people would have been a little wary of the concept of this advice, and are people just trying to sell something just because something is more lucrative. So that could have been the misapprehension which they would have had.
Okay, so what is there something you would like to tell a person who is seeking advice but is hesitant to do so?
See, what we need to know is there are times when probably you might be aware of a lot of things, but there could be a lot of other times when our awareness would be limited. Secondly, while we would be aware of a lot of things, our bandwidth in terms of time which can be given to the regular monitoring and the reallocations would be limited, because we might be into some other kind of role. Our professions could be very different. Our investments which we want to give time to, we may not be able to devote so much of time. So in all these cases, you would need a support of a advisor who can help you, one, to get your plan in order, as we said earlier, and second is also to regularly monitor this and guide you, because one is to make the plan, second is to ensure that the discipline is maintained at all points of time. So you got into a plan which said that you need to have 60% into, say, equities, and equity markets had a fantastic run. The 60 became 80 because of the mark-to-market appreciation which you got. So here, probably we ourselves may not be able to take that objective decision, because you're seeing something doing very well. I would say let it be there, because it's still making money for me. Why should I reallocate? So that's when an advisor would come and say, no, probably it's like, to put it in a very common parlance, it's like blood sugar. So you like sweets, but at some point of time, if that sugar goes beyond a limit, the doctor comes and says, stop it. Correct? You have to cut down your sugar intake. Similarly, the advisor would help you and say, probably your risk element in your portfolio is growing. This is the time you need to readjust the portfolio, even though the returns could have been very good, but you need to readjust the portfolio. So that's where the role of advisor comes in.
So how important do you think is regulation in the industry, and what role does it play in gaining investor trust?
It's a very interesting and very important question. In fact, as we were discussing, one of the reasons probably people were a little averse to getting advisor, or they were a little, as I said, there was a lot of apprehension whether the advisor is giving the right kind of advice. Regulatory framework can remove a lot of the fears which people would have. And more importantly, it gets in that most important thing, which is the trust.
Right.
How? It gives you transparency. So the advisor is very transparent.
Yeah.
The investor gets to know what the underlying portfolio is. So there's a lot of trust, mutual trust, which gets built in. And that is the essential part of this whole journey together. So that's where regulations play a very, very important role. It also acts and creates a lot of checks and balances. So obviously, there could have been some mistakes of the past, which could have been there, on both sides. And with regulations, you'll be able to put a very clear guardrail to it. You will ensure those kind of mistakes, those kind of challenges don't come. If at all it comes, it's going to be very, very minor. It's not going to be major. So that's where regulations come in. It builds a very clean, a very, very friendly ecosystem for everybody to be there and maximize whatever is their objective within that framework.
It is often seen that investors often choose funds based on past returns. So can you explain with a real scenario why this can be risky?
This typically keeps happening, and to be honest, at times returns are the most easier thing which somebody can notice, correct? So when an asset class does well, naturally there are a lot of takers for it, or people have this as we call it FOMO, fear of missing out, because I could see my neighbor gaining, my watchman says I have made money, so everybody else is speaking, and I believe I have not been there participating in that. So that's what typically happens. So real life example, there are plenty of them. So typically equity markets or equity as an asset class can be very rewarding from the longer term perspective. So across the globe, including India, which now we have a 40-year plus history, we have seen this asset class actually has delivered better than most of the other asset classes. But it is still prone to huge swings or huge volatility, and which is what one needs to guard against. A simple case in point, we have seen a glorious spread between 14 to 17 equity markets did fantastically well, and where the returns would have been upwards of 20-30% compounding, which essentially means you would have almost doubled your money on a 2 to 3 year time frame. And then came 18-19, typically was a very, very flat year for the markets, and there was some correction in the early 20s when COVID stuck. So in that next 3 years, hardly any kind of returns would have been in the market. So people who got in seeing this first 3 year returns would have burned their fingers. Something similar has happened in the very recent example. So we had seen a strong market rally between 2023 to 24. So somewhere in March 23 onwards till about September 24, markets did phenomenally well. In fact, the entire belt between 20 to 23, most of the funds would have doubled in a 3 to 4 years kind of time, 20 to 24. So between 2020 and 2024 on a 4 year time frame. So most of the funds, or some of the funds, especially the broad-based kind of funds, which are mid-cap, small-cap, would have seen almost 20% plus compounding, which is almost equivalent to doubling your money in a 4 years time frame. But then last 15 months, we would have seen a very, very muted performance, some of them even negative kind of returns. So this is what people will have to guard against. So even when we say that long-term equity returns have been good, last decade has been excellent for equities, have delivered 15% upwards compounding, the fact is there could be only 3 or 4 very good years for the market, and rest of the years would be slightly moderate, some negative. So it's going to be a mixed bag, which is going to be there. So
from a product perspective, what are the 2 to 3 things that investors usually forget but advisors focus on?
As I said, the core, which is the core for any success with in terms of wealth creation, lies in asset allocation, correct? Right. So one of the common mistakes, as I said, is dictated by these emotions of greed and fear. So if there's one asset class which is doing extremely well, it could be precious metals, for instance, today. Maybe a year back, it could have been equities. Maybe a few years before, it could have been fixed income. There is always the lure of trying to catch the momentum, correct? And that could be one common mistake which can happen. And probably you may not realize what kind of underlying risks go with that. So that is where an advisor will help you understand not only the return potential of an asset class, but also what kind of risk that asset class would carry. So when you are making your plan, and you will have to first understand whether you are willing to take that kind of a risk. So that is one challenge which can happen. Second is, after the investment is done, is typically you will get dictated by the market news flows. So today we live in the WhatsApp university world, where we keep getting a lot of information. So there's information overload, correct? So which is why we say that we need to do declutter in terms of this thing, correct? So that's become a big term today. So we try to get away from our phones, get away from the media, because so much of news flows coming in. So you not only know what is happening in India, you get to know what's happening across the world. So all that could influence your thought process. So there are times when you think everything is bleak. Again, COVID is a very easy example. 2020, when COVID stuck, pandemic stuck, obviously none of us has seen something like this of the magnitude and impacting the entire world. So naturally, everybody were quite worried, concerned, and people were pulling money out of the asset classes like equities, which was considered to be more risky. But within 3-4 months of COVID setting in, we could see a strong market rally happening. So had you taken a call on that basis, probably most of us could have missed out on the return potential, which happened for the next few years. So that is where I think 2-3 things which can go wrong, and which is when an advisor can come in and can handle you through these periods without. So it's always important, because see, at times we can be too much glued onto the near term, and which is where you need a more objective person to come in and help you with that, and that's the role an advisor can fulfill.
So you mentioned information overload. This is not something that we can avoid naturally, right?
Absolutely.
So, and when times are bleak, right, it is very natural that we will refer to anything that is accessible to us.
Correct.
So what do you think a person should do in such a situation?
So that's exactly the reason. What we said is you need to build a rule-based kind of asset allocation. You say, this is my asset allocation, I'll stick to it come what may, correct? And there can be fixed periods for reviewing this, maybe once in a year or whatever frequency you decide. And then accordingly, you keep rebalancing the portfolio, because that's the best way to try and tide over this kind of news flows, because we know this is going to happen. See, this is an interconnected world. You will have some problem somewhere across the world, but doesn't really mean you should lose focus. So that's the only way. So which is why discipline investments, while it might sound a little boring, the fact is you need to be disciplined and keep managing your asset allocation in the right manner as you want. So these two things are very, very important. So it's like a doctor telling you that you need to do your exercises daily and have the right kind of diet in your food. So then most of your diseases will take care of itself. So it's something similar when it comes to investments. And you could say the advisor is more like a doctor who comes and who advises you, hands-hold you to the difficult times.
So you mentioned goal-based investing. So how is goal-based investing different from investing regularly?
So quite different actually, because goal-based investing is you have a very clear goal in mind, correct? So you say that I need to go to Switzerland, say in 3 years down the line. I need to buy a house 5 years down the line. My child's education 10 years down the line. 20 years down the line, my retirement planning. So all these are different goals which I set in. So once I get to this goal, and I put in a time frame to this, say 3 years, 5 years, 10 years, whatever the case may be, then the second step would be to try and look at the right kind of products which can help me achieve this goal. And then I put an amount to it, what kind of money I would want to. For example, today my lifestyle, say I spend 1 lakh a year, possibly 10 years down the line, I need to spend 2 lakhs a year to maintain the same standard of living, because it's going to be inflation adjusted, correct? So all that is taken into account and goals are getting created. The second is investing for the long term. So once you decide the goal, then according to your goal, your investment tenure will also change. For example, if you're looking at a retirement planning, maybe 20 years down the line, 30 years down the line, that is long term for investing, correct? And there, how do you build corpus for that? So one of the ways to do that is something called as systematic investment, SIPs, which has become quite popular in the industry today. So it is basically an opposite of EMIs. Normally, most of us have home loans, housing loans, where we pay equated monthly installments. Here, it's equated monthly investments. That's the difference. So the idea is all of us will not be able to set aside a big amount for savings or for investments on a monthly basis. So you put in small tranches, how much is possible, and then you keep investing it for the long term. That gives you two aspects. One, it gives you the power helps you benefit from the power of compounding. And secondly, it helps you because there's an investment discipline, because there are small amounts which goes on a regular basis. You would not get swayed so much by the market shifts, and you would look at from a long-term point of view. So in that sense, you could say one is subset of the other. So goal is at the top, and then your regular investments is a subset of this goal.
Say a 22-year-old is listening to this podcast. What's a 1 year money move they can make this year?
I wish we had an answer to that. See, as I said, it's not about 1 year. It's a question of what is your goal from a long-term perspective. Say you've got some corpus today, and you say after 1 year, I want to go to Spain. Correct. And you know that you need to spend at least 2.5 lakhs there, and today you got, say, close to that money. Then the idea would be to put it in some instruments where your capital will be saved, plus there is some returns which is better than inflation, which is accruing. Second aspect is, I don't have that kind of money. Probably give yourself some time, maybe 2 years, 3 years. there can be appropriate products which can be built. It could be hybrid products, it could be equity-oriented products, it could be fixed income products, a combination of these to ensure that you somewhere get to that goal from a 3-year kind of time frame. So that's how we should think. See, what we should not forget is there are some basic tenets to investing, especially for people like you who would be just beginning their career, just starting off with their this thing. So naturally, when the initial paycheck comes in, it's not going to be large. All of us understand that. And probably the inclination would be to splurge, because there are a lot of items, luxury items, premium items which you want to buy and which you want to splurge, which is fair. But there's always a cost of delay which comes in. So we keep harping on this kind of examples where even a 1-year delay, for example, you save 15K on a monthly basis, and that asset class wherever you invest is able to compound this at 12%. It's something like over a long time period, 30-year period, this can become as big as 8 crores. And if you miss it by 1 year, you probably end up making 1 crore less. Okay. So that tells you the cost of delay can be huge. Right. So even from the starting years, in fact, that's the best years for any investor. Well, it's difficult. Probably some of us in our generation wouldn't have got this kind of an advice, but probably with your generation, the ability, because you have so much of access to information and you could always learn with history. What it tells you is probably that initial years, when your ability to take risk is significantly higher, you could go to asset classes which probably can be more rewarding from a longer term perspective. And that can actually help you build a very, very important retirement corpus.
So let's move on to a quick rapid fire session. Long-term investing or short-term trading?
Long-term investing.
SIP or lump sum?
Combination.
Advice or information?
Advice.
And why did you suggest combination?
So basically what happens is all of us go through life cycles as we know. So initially, as I said, the paycheck when we start, typically it could be a little less. And hence probably we will have smaller quantums to invest. And starting SIP would be a better way. But as we grow, obviously our paychecks are expected to go up. Our income levels are expected to increase. So there could be times when you will have some bonuses coming to you, some other money coming to you. So there could be a combination of lump sum and SIPs which can be also envisaged. Also, there are times when there could be top-ups done because your incomes is going. So all this would be, if you do a combination, you can accelerate your potential long-term goals which you have in mind.
And what's one tip that you would like to give to our listeners?
So there's no tip. As I said, investments, to be honest, if you really want to make investments successful from a longer-term perspective, the advice is quite boring. Just like the doctor says, do exercise and eat the right kind of food. But there is no other way out, to be honest. So one, have the right asset allocation plan in place, which is where you can take advice, you can take help from people who understand better, who can be more objective. Once you decide that, second is to be very, very disciplined. See, not at all easy. Both these things which I am saying is not at all easy, especially the discipline part, because you will get swayed by so much of information which keeps coming, so much of things you keep reading, you keep hearing people. And that's where you need to have that kind of a objective mind, and which is where probably an advisor can help, because somebody you can look at slightly different than what we would get swayed by emotions.
If an investor listening today had to take just one action after this podcast, what would it be?
So basically the key message which all of us should understand as investors, that each asset class would carry its own set of risks and potential growth opportunities as well, correct? So that is one important thing. We need to understand what kind of risks we can take. Once we understand that, then it's easy for us to plug in the products. Second is, one common mistake which we do is to tend to chase the momentum or nothing but the past returns. So there also it's important for us to take a call whether this product suite actually fits in to our risk profile. If it does, then it merits allocation. Otherwise, we'll have to think of alternatives, which is there. So that's one important thing. To put it in very simple terms, we need to marry our investments with our goals and ensure the right kind of products are plugged in there.
And what's the one money principle that you strongly follow?
Discipline is the only way that you can make your wealth creation a success from a longer term perspective. Short term, maybe we can get lucky by chance, but it may not repeat always. So discipline is the key aspect. Apart from asset allocation, discipline is one key quality which we need to bring in.
Thank you so much for being a part of this podcast. I really hope the listeners have taken great insights from you, and we are very honored to have you here.
It's my pleasure. Thank you for having me here. And to be honest, this is just a journey. So all of us keep learning across whatever happens with the market. So we hope you and your investors have a great journey ahead. Thank you once again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.